In this video, we cover the issuance of bonds, the most popular form of financing used by large companies worldwide. This form of financing is so popular relative to bank loans because it spreads the risk associated with buying debt securities across a wide variety of lenders or bond investors, which in turn lowers the issuer's cost of borrowing, normally reflected in paying a lower interest rate. Later in the video, we take a close look at the financial statements and footnotes of the General Motors Company, which is active in bond markets pretty much every year. Here's how a bond issuance basically works. It starts with a company in need of a large amount of cash, often to fund a major project. During 2016, for example, Anheuser-Busch raised $46 billion with a bond issuance, and Apple and Exxon each raised $12 billion. The issuing company contacts one or more intermediary firms, normally investment banks. Well-known investment banks include Bank of America, Merrill Lynch, Citigroup, JP Morgan Chase, Goldman Sachs, Credit Suisse, Barclays, and there are others, large and small. Together, the issuing or borrowing company and the investment bank work out the terms of the bond, which include the selling or issuing price, the timing of the contractual cash interest and principal payments, and other terms. The investment bank then sells the bonds to the investing public and collects the proceeds, taking a fee for its service, and then paying the remaining proceeds to the issuing company, which is now contractually required to make the debt payments to whoever owns the bonds, the bondholders, over the life of the bond. Keep in mind that after bonds are issued, they are traded among different bond investors on the bond market throughout the life of the issuance, where their prices change from day to day. We cover accounting for bond investments in video 44. To understand the economics underlying bond issuances, assume that an investment bank is offering to sell bonds to you, a potential bond investor. The bonds are being issued by Acme Products Incorporated to fund an expansion of its business into a new geographic region. The terms of a single bond. First, the face value is the cash payment made by Acme to the bondholder at the end of the bond's life, the maturity date. It is $1,000 in this case, which is true for almost all bonds. Next, the time to maturity, or the life of the bond, is 2 years, meaning that the face value payment will be made at the end of 2 years. In the real world, bond lives are normally longer than 2 years. 5-year, 10-year, and even 20-year bonds are common. The stated annual interest rate, or sometimes called the coupon rate, is stated on the face of the bond and determines the annual cash interest payment made by Acme to the bondholder, and in this case it is 8% of the face value, or $80 per year, 8% times $1,000. There would also be other terms, including covenants, collateral, and call provisions. We will ignore them for the time being. And finally, the asking price per bond, which in this case is 96.5% of the face value, or $965. This amount was worked out in advance between the issuing company and the investment bank, considering the terms of the bond, market conditions, and the financial condition of Acme, the issuing company. This is the amount that they believe bond investors are willing to pay for a bond issued by Acme with these terms. Let's take a look at the future cash flows created by this set of terms. $965 would be collected by the issuer at the date of the issuance, ignoring any investment banking fees. Interest payments are usually made twice per year, so Acme would pay $40 every 6 months, 8% the annual stated rate, times $1,000, the face value, divided by 2. And on the maturity date, at the end of the second year, the issuer, Acme, would pay the face value to the bondholders, $1,000 for each outstanding bond. As a bond investor, would you be willing to pay $965 for the right to receive this cash flow promised by Acme in the bond contract?
So, would you buy the bonds issued by Acme? How would you make that decision? What kind of information would you need? How would that information be reflected on the financial statements? This video goes on to answer all those questions, as well as other questions that surround the issuance of bonds and how they look on the financial statements. This video is one of 6 videos in this course, 2.5 hours. And in total, they come together to cover the idea of capital structure. That is, how does management finance its activities? Do they go to the debt market and borrow? Or do they go to the equity market and sell off ownership? Those are the 2 basic ways to finance. That's what the capital structure is all about. And very much like the next 2 courses in this series, this course takes a deep dive into real-world financial statements. Featured in this course are General Motors, the motor company, Volkswagen, another motor manufacturer, but this one uses IFRS financial statements, Amazon, everybody knows the great Amazon internet company, Home Depot, a giant in home improvement, and Panera, a very successful restaurant chain.